Cool. Well, let's just get going here.
Perfect.
For everyone out there, we are sitting down with Carese Busby, Caliber Home Loans. I've worked with Carese forever. Refer a lot of clients. Tarks just everyone loves working with Carese. Super knowledgeable about the market and is just really, really good with the details and working with people who have a lot of questions about, the mortgage industry and how to purchase a home. And when I have a client specifically that I know that might need a little bit more detail or hand-holding, Carese is the angel that comes in and just makes everything so smooth, and everyone just loves working with her. So thank you for sitting down with me today and doing this. I think we've talked about before. It's just really good to sit down, see each other's faces, and kind of talk shop about what's going on in the markets. And I follow the mortgage industry pretty closely, but it's always good to hear it straight from the horse's mouth and to hear your different perspective on what actually is going on. So, we'll just kind of dive in. You want to chat about kind of the market and what that's been doing lately?
Yeah, absolutely. Well, first of all, thank you so much. It's truly my honor to join you. And I always love working with you and your clients, and I love helping people. So it's a lot of fun for me to get into the details because I love the details in this business. So yeah, the market is good. It's pretty interesting really what we've seen happen. I think a lot of us, everybody, when we started into this pandemic in February, March, a lot of us didn't know what to expect. We didn't know what would be the effect on the market, what would be the effect on the housing market. And what we ended up seeing is back in March, stock market got a little bit volatile for a while. The Fed really got that into check, which was great, calmed the markets down, and rates plummeted to absolute historical lows, which has really created a great opportunity for clients that own homes, clients that want to get into homes, because, the lower the rates go, the more buying power people have. And, we live in a pretty high cost area where there's been a lot of people that have thought, well, I just can't afford to buy, so I'm just going to rent. It's really created a lot of opportunities. The good news is, people, I credit everyone because everyone's had to work together in this pandemic, but the market is coming back really well. Companies are opening back up again. The markets have been pretty darn stable. If you have money in a stock market, money in a 401k, your account is doing great. That also is a good measure for how the economy is doing in general. This pandemic was something no one in our generation has ever experienced.
Yep.
And it really is kind of a point in time where we had to just shut the economy down. It's been interesting to see that as it's opened back up, companies have come back. We see sales up 6% year over year in our area. Our area is unique because it's a high activity area. A lot of people want to live here. There's still a lot of multiple offers. But I think low rates are really driving the market. The Federal Reserve talked a couple weeks ago about their forecast, and they really expect rates to stay down in this low range until about 2023. So that's great news. And every year unemployment is expected to continue to be lower and lower as we recover, which will bring more buyers into the market. But it's really nice to know that we'll have a long-term effect of low rates. That's going to help a lot of people.
Yeah. And so those low rates, are we talking all different types of products? Because, we're with what's going on, we're seeing a lot of secondary home purchases. We're seeing a lot of actually 1031 exchanges too from investors who are looking to get out and move it into other properties. So are they pretty consistent across the board?
They are. So in King, Pierce, and Snohomish counties, those are considered high cost areas. So every year, Housing and Urban Development, which is a federal agency, looks at the median house prices in every county across the nation, and then they set what we call the conforming loan limit. at a certain amount. Right now, that's at $741,750 for 2020.
Yep.
And what that means by conforming loan amount is that's kind of your traditional loans that everybody sees advertised online. So they have the most flexible guidelines. They allow for 5% down, 10% down, 3% down. They're just more the standard loans that most people are going to be aware of. And so that loan limit in King County is $741,750, which is great because it captures a lot of people that would ordinarily find themselves in what we call a jumbo type loan product, which is any loan amount above that $741,750 threshold. And it has just tighter guidelines, requires a bit more down payment. But across the board, yes, just this week, Freddie Mac was quoting the 30-year fixed average across the nation was at 2.87%, really low. And that's assuming 0.8 in points, so like 0.8 buy down points. The 15-year was at 2.37 as a benchmark. Average with 0.7 in points. Now that's for conforming loans under that 741,750 mark. When you get into jumbo, those rates are a little bit higher. And that's because they're considered riskier loans, they're higher loan amounts, there's more at stake, the underwriting guidelines are a little bit tighter, but still, even those loans run 0.25% higher, maybe.
Yep.
So really low across the board.
And then, so are you finding that people are doing more of the 30-year fixed versus doing the ARMs? Because I know that the ARMs are pretty popular a few years ago.
Yes, the fixed rate products right now are by far the best in the market. And the reason why I say that is the ARM loans, there are exceptions to that rule. Sometimes you'll find some private money, typically for jumbo loans, where they will choose to what we call securitize that ARM. And so they'll kind of go out and they'll offer a great rate on an ARM for a really limited, but pretty tight guidelines. A limited group of people will qualify. But the vast majority of the marketplace right now, the ARMs are not in favor. And the reason for that is what drives interest rates is anytime you're making a loan to somebody, there is an investor that buys a security on the other side called a bond security. And right now with the uncertainty in the market, those investors are buying long-term securities. So that's why you're seeing the rates come down for 30-year fixed, 15-year fixed, because they're the longer term securities than you're seeing for a shorter term security. So I haven't done an ARM loan for a client in probably 6-7 months because it just hasn't made sense. Sometimes they price worse than the 30-year fixed.
Yeah, it's all very interesting how that, depending also too on the appreciating markets and how, a lot of people did the ARMs back in there, let's say 2011 to 2014 probably, because you're also in an appreciating market and, you're more of a short term, the 5-year, the 7-year, the 10-year. So just kind of depends on what the market is doing too.
Yeah. The other thing that's interesting is there's now enough research after the financial crash. Before the financial crash, people kept their loans an average of under 4 years. Now, over the last 10 years, that it's longer. People stay in their homes and are keeping their loans closer to 6 to 7 years. Yeah. So it's a longer period of time. And so the ARMs were a lot more popular when those were turning over more quickly.
Yeah. And I guess people now too, with interest rates have been so low for so long, they're staying and refinancing too. So that's probably another trend. I mean, obviously we're going through a refinance right now. And I think that's also been a huge trend this year as people hunkering down, staying in their current home also, and just basically refinancing to get the payments down lower.
Yeah, absolutely. Yeah, there's a lot of trends that we're seeing this year. That's pretty exciting actually. And the trends that we're seeing is a lot of people are, if they really like their house, they've either determined with this lockdown and homeschool and all that, hey, we love our house, we love the location, we want to do a remodel. So we're going to look at doing a remodel, and that can be financed through a cash out refinance where you're tapping into equity in the property that you currently own.
Mhm.
And people can pull out the equity out of that home to pay for that remodel, or potentially a purchase of a new home that they want to make. So the construction industry is really benefiting from this, the pandemic response, I should say, the reaction coming out of the pandemic, because a lot of changes have happened. And so yeah, people are doing projects, cash out refinances to do remodels at really nice low rates, or they can just do no cash out refis and save a lot of money, help their cash flow, shorten up that term of the loan if the goal is to pay the loan off quickly.
Yep.
Lots of different options.
What are those rates that you're finding for those cash out? Like, what's an approximate?
Yeah, I mean, those definitely price higher. You're looking at about 1/4% to 3/8% higher on a cash out refinance than you are.
If you think about a loan rate and what you'd be paying for that, right? So it's
Yes.
more reasonable to do one of the cash out refinances than to go get a loan. You know?
It's still it's still the least costly and most efficient way to finance a home project.
Yeah.
If you're going to be putting money into your home, you might as well finance it with equity from the home. And you're exactly right. It's definitely less expensive. The rate's going to be lower. The costs are going to be lower than putting the money on a credit card or getting a personal loan that's not tied to real estate. Those rates are always going to be higher.
So speaking about the cash equity refinance, so a lot of people use also that as a strategy to purchase a new home.
Yeah,
so
that's a great strategy. So in our area, a lot of people have a good amount of equity in their current home. And as we know, with the competitive market, it's really challenging to find a scenario where you can write a contingent offer. And some people want to keep the residence that they're currently in to become a rental after they move into the new home. So one of the strategies that we'll use is doing a cash out refinance on the existing home, pulling that money out. And I always recommend that we do that about 6 months before the client wants to find another property to purchase, just so that they're not in a time crunch, because refinances do take longer to process than a purchase does. So it's always best if we can do that ahead of time, and just the client could just put the money in a very conservative investment, earn some kind of interest. With money this cheap, it's a great alternative. And then the money is just sitting there, and when that right house comes along, it can be used towards the down payment of that next purchase without needing to do what we call a bridge loan, which can be a lot more costly.
Yep. Or just straight up doing a contingent offer because you're trying to sell the property too. So it allows a little bit more flexibility there.
And to be more competitive. Yeah.
Sure. What else are you seeing as far as buyers that you're helping them with, as far as the pre-approval?
Yeah.
Obviously, we know that not every single, but the majority of transactions that are happening out there right now are definitely multiple scenario. Single family, townhomes. So what are the types of things that you're recommending to your buyers and kind of talking about with the agents that you've been working with?
Yeah. So it's interesting, there's a few different trends. So we're seeing a big uptick in first-time home buyers. And a lot of this has been predicated on coming out of this pandemic. Companies have revised their policies on remote work. Yeah. And a lot of companies have decided to go permanent remote work. So previously, would-be buyers were stuck in this conundrum of, would I prefer to live closer to work in a smaller space and not have a commute, or I can move farther out where I can afford the kind of house that I really want to live in, but then I have this commute. And so now that conundrum has been resolved in many cases, because these would-be buyers either don't have to come into the office anymore, or they only have to commute maybe 1 or 2 days a week. So it's allowing them to go farther out and go and buy into more rural areas, more the suburbs, and purchase a home and take advantage of some of those first-time homebuyer programs, lower down payment programs. Through the Washington State Housing Financing Commission, there's some great programs where you can actually get into a home with zero down. Of course, it's always important to note when talking about these programs that everybody has a different and unique scenario. So they should always talk with their loan officer, get pre-approved to determine which program is going to be right for them. But there's a lot of great first-time homebuyer and low down payment options for people. Yeah. Another trend that's really interesting is people can now buy second homes in areas they really love because, again, they can work remote. And so we're seeing that trend of that either choosing the smaller home here locally and then purchasing a second home in a market where they maybe really love the weather.
Arcadia. I mean, Arcadia has been a huge force, and a lot of people have chosen to purchase over there, and because it's an hour and 15 minutes, it's so easy to get out of the climate here into the sun.
Yes,
so that's a trend for sure.
And second homes, you can buy a second home with as little as 10% down, depending on what that purchase price on a conforming, loan limit, which again in King, Snohomish, Pierce County is up to 741, 750. In other counties, it's 500. Nationwide, it's 510,400 right now. But 10% down is great. And second home rates are priced comparatively with primary residence rates because it is an owner occupied property, because the buyer is going to be living in that property for a certain amount of time during the year. Yeah. So the second home market is really booming. And again, like what I was saying, doing remodels, I think there's going to be an uptick in construction loans, people going out into areas, being able to buy land again, construct a home from ground up. We haven't seen that trend in a while. Mm-hmm. So I think we'll see more of that for sure.
Yeah, that's great. So when you're working specifically with these buyers who are in these competitive market situations, though, I mean, you start with the pre-approval process.
Yes,
and
absolutely.
They basically fill out the application. And why don't you talk just a little bit about, what that looks like?
Yeah, absolutely. So if someone's within about 6 months of wanting to buy, definitely get pre-approved. Pre-approval process is not painful. It's pretty straightforward. So we have a client fill out a loan application. It's electronic, so it's pretty easy. They could fill out the loan application, and then we'll give a short list of financial documents. So I would say to prepare, it's always great for buyers to make sure they keep their pay stubs. So keep copies of the pay stubs, because the lender's always going to want the most recent 45 days of pay stubs. W-2s for the most recent 2 years. So keep those W-2s handy. Most recent year's tax returns. For self-employed people, I always recommend too, it's great, especially as we're starting to go into a new year, get the tax return filed right away. Because in order to use that income from the previous year, the tax return has to be filed. And in many cases for buyers, that previous year was a good year. So of course they want to be able to use it. So get the tax return filed. But the pre-approval process, it's filling out a loan app, submitting financial documentations, pay stubs, bank statements, W-2s, tax return. And then we do a qualification analysis to determine what you qualify for, which programs you're eligible for. We do review a credit. That's where we can determine, is there anything showing up on credit that maybe a client didn't know about? They have time to get that resolved before it's time that they want to put in an offer. Because a lot of times what happens is people don't anticipate finding a house and then they're out driving and they fall in love with the house. And so definitely best to be prepared. Yeah.
What about gift funds for those maybe first-time buyers who're receiving funds from parents, or I
Mhm.
think there's a certain amount of months that it needs to season, the funds need to season.
Yeah. So the great thing is for primary residences and second homes, you can receive gift funds from family members or a fiance. So that money doesn't have to be seasoned. So at the time, so if you go into contract and then we will walk you through the steps of exactly what needs to happen. But generally speaking, what's required in a gift scenario is there's an industry standard gift letter. And in lending, we have to document the transfer of funds from one party to another if it's over 50% of a borrower's gross monthly income. And so the gift letter is the acceptable way to explain what those funds are and who they're coming from. And we just need a copy of the wire receipt. So the donor wires the money to escrow, and then we just get a receipt from escrow that shows that the money came from that donor for the gift funds. We document it with a gift letter, and then that's perfectly fine for the file. And that doesn't have to be seasoned. Now, if money is coming from a foreign, so let's say we have money coming from China or family, really anywhere, Canada, the UK, Israel. I've worked with clients with all of that, and we can document it. It's not a fun process to document. So I will always recommend, if at all possible, if you are using any foreign money or money that's outside the US, get the money into your US bank account right away and let it sit there for 60 days. Just because once it's sat there for 60 days, we don't have to ask about the origin of where it came from. And it's just a lot less documentation for a borrower. Yeah.
I mean, the lending process sometimes be cumbersome because I think buyers, and I always stress, I know you set the expectations too, but it's, it's not over till it's over. And you might be getting, the day before, even the morning of closing, you might be getting, a request saying, please update this or provide me this. So, it's for a good reason, of course. But yeah, it's always, but good to do all that work pretty much up front. So when you're ready to go, and especially in competitive market scenarios, right, that you're able to say, no, they're fully underwritten. We just basically need to have either appraisal or we have a waived appraisal or whatever it is. So it's as good as cash.
I've always looked at it as we want to set the buyer up for success. And going in and making an offer, it's already, most people are nervous and it's a new experience and you're talking about a lot of money. So the more confidence we can instill in that buyer going into that offer, the better they're going to be. And so by doing that work up front, we vet the loan and we vet the client so that there aren't those surprises on the back end. No, I've never met anybody that likes bad surprises. So we really try to eliminate that as much as possible. But to your point, it's normal in the lending process. I explain to clients, this is an interactive process. I wish I could send you one list and that's all we're going to need. But there's no way for me to know exactly when the loan goes in underwriting. There's always going to be some follow-up items that the underwriter needs. So it will start to feel like it is a bit of a financial strip search, and it is. But here's the good thing. We always, in this country, we always learn from past experiences. One of the things that financial crash taught us 10 years ago, and this is why I don't think we'll be in that position anytime soon again, is through that crash, there was some guideline changes. And it really requires lenders now to vet clients, to really go through and make sure they have the ability to repay that loan. And so by doing that, these files are well documented. And that's the part that I explain to clients is, I know it's a lot of work. I know you feel like you keep turning over documents, but the good news is it also means that the economy is going to be safe, and you're not going to probably have to ever experience what we went through 10 years ago because these files are being documented.
Yeah. So I guess you want to talk a little bit about, well, is there any other tips that you want to kind of touch on that we didn't cover?
Yeah, I think that some of the biggest questions I get with respect to, hey, I want to look at buying a house over the next 6 months to a year. Some really important things to consider if you're looking to do that is, don't make major job changes. And when I say major, it's like, don't go from being a salaried paid employee into being self-employed or 1099. Now, you can go from being self-employed or 1099 into being a salaried employee, but the opposite is problematic because with self-employed or 1099, you got to have 2 years of proof of that income before you're going to be able to be eligible for a loan. If you go from self-employed to salaried, not a problem. As long as you're a full-time employee and it's salary, once you're on the job 30 days, you're good. Some of the other things that I'll notice too is if you're going to make a major purchase like buying a boat or buying a car, it's just important you work with your loan officer just to make sure that that isn't going to adversely affect your ability to qualify for that price range that you want to qualify for when you get to that point. Yep. The other thing is, and this is probably a good segue into forbearance, is if you currently own a home and you're thinking about forbearance, you really want to think hard on that. So forbearance, kudos to the servicers and Fannie Mae and Freddie Mac for getting out in front of this pandemic when it happened and helping borrowers and coming up with a solution so that borrowers' credits wasn't going to be damaged through going through an adverse event. Maybe they lost their job or they were furloughed for a while and couldn't make their payments. The forbearance is there for people that really need it. And for people that really need it and are having trouble making their payments, they should absolutely take advantage of it. However, there are some sticking points to it. So if you currently own a home and you're thinking, well, I might want to refi, or I might want to buy a home in the next 6 months or a year, you want to think twice about it, and here is why. Because the way the rules work is if you want to qualify for a loan in the future, you have to exit the forbearance. If you're in a forbearance, you have to exit it. You have to bring the loan current, which means you either have to write a check for whatever amount you're behind or work out a payment plan with the lender. And then you have to make 3 new payments. So 90 days, you got to make 3 payments when they're due under the new loan terms before you can get pre-approved or refinance on a property.
Yeah, that's interesting. And especially important for people who own multiple properties, or they have one rental property or investment, and they're looking at refinancing maybe their personal home, but then let the rental or investment property kind of go into forbearance. Actually, I had a client that happened to, kind of got caught up in that whole thing too. So very, very important to know. So with that, also, I think we kind of talked like PPP when buyers going to apply. How does that affect kind of the whole loan scenario?
Yeah, with the PPP and the SBA business loan, it really depends on how it shows up on their credit and whether the loan is required to be paid back or not. If it's a forgivable loan, then it really doesn't factor in. If it is not a forgivable loan and does have to be paid back, then it does have to factor in to the qualifications. It also cannot be used towards like down payment funds, closing costs. In many cases, though, people got PPP loans back in the spring, and so now when you're looking at the bank statements, the funds are already in there, so a lender wouldn't know the difference. So it probably wouldn't even factor.
Yep.
Yeah.
Good. And so then with the SBA loans where they are deferred payments, those are basically, it's treated in the future as potentially your debt to income ratio could be.
Yes. So even if they're deferred, much like how student loans are underwritten, even if they're deferred, we're required, like in the case of a student loan, if there's not a payment amount showing, we use 1% of the balance. But typically under the SBA loans, they will assign like a payment amount. And it'll note that it's deferred, but for underwriting, we're still required to factor that in, because lenders under the Dodd-Frank legislation that was passed in 2010, coming out of the financial crash, lenders are required by law to fulfill a certain requirement called ability to repay. And so that falls under that ability to repay requirement, where you've got to make sure that if you know something is going to be required to be repaid starting within 3 years, it has to be factored in. Got
it. Yep. Yeah. And so that doesn't necessarily mean that they can't get the loan if you have an SBA loan attached to your name or your credit. It's more so just it affects the debt to income ratios and is taken into account with the entire file.
Correct. Yeah. Yes.
What other, I'm just trying to think of the other things. We've kind of covered a lot of topics.
There's been some updates to guidelines, underwriting guidelines. There have been some tightening, especially for self-employed borrowers. So that's why I always say it's really important for self-employed people to file their taxes when they can. We will ask for a year-to-date profit and loss. And so long as the income is on par with the year before, then we always are going to use the more conservative of the two. So, with the pandemic and businesses being closed, as lenders, we have to verify, businesses are back up and running. So we're having to do some additional requirements, like looking at a most recent bank statement to show there's really business income coming in. So that's really been the lion's share of the changes, is really taking a critique of the profit and loss statements and looking at bank statements to make sure the activity in the business is on par with the financials. And, there's been some changes to the bonus and commission income is scrutinized a little bit more. Again, just have to verify it's continuing, that there hasn't been a drop off in it. And rental income, that's an interesting one. Right now, it's really important for especially property investors that buy rentals. If the property is currently rented out, if they're buying a property and the renter is in the property and will continue to be in the property, you can use 75% of that rental income to offset that payment. But if it's an empty house, then you can't. Client has to qualify with that full amount of the rental income.
Got it. So with income, do you have to do verification, like have the lease agreement? You guys require all that stuff?
Yeah, lease agreement that just shows they're going to continue to stay in the house. And a lot of that has been, and people that currently have rentals that they're renting them, we have to have proof that they're receiving rent because of the governor's order of people being allowed to not make rent payments right now. So in order for a lender to count rent, we have to verify the borrower's actually receiving the rent. So it's just two bank statements that just show, yes, we're receiving rent on the property. And then of course it can be used. Jumbo loans have had some guideline changes, mainly on down payment. The mainstream jumbo loans, the best interest rate loans, are going to always require 20% down. There still are some options to do 10 to 15% down on jumbo. But it's the income is underwritten a little bit more strictly during this time period with the pandemic. But really, as a whole, it hasn't been that negative on. I haven't had any borrowers that were kicked out of being able to continue on their transactions because of it. So that's a good thing.
Yep. I think for the most part, we powered right through March. There was a little bit of a fall, for us, just in terms of being on the front line, from some of our buyers that had change of employment, or maybe they got laid off, or, during that late February to early March. But after that, everything kind of seemed to mellow out, and we've been pretty much, status quo with our crazy numbers and limited inventory
Yeah.
and increasing values, multiple offers and everything too. So
Well, I think it's really allowing people to think about where they're kind of relook at their life and
oh, yeah.
reprioritize and think about, where do I want to spend my time? Am I happy where I'm living right now? Do I want to make a change? So it's really interesting how sometimes a kind of a tragic type event can bring about some great opportunity for people too. I just see nothing but it. I think in the future, we're going to continue to see more and more companies allow that remote flexibility.
Mhm.
And that's great for the housing market.
Yeah.
That's really great.
And I do think, though, some people do like to get out of their house and separate their work from home too. So I think that there's a fair share of those people out there still, that are like, no, I cannot wait to get out of my house. I want to go into the office.
Go back to the office.
I do want to see my colleagues, or that's just how they operate, maybe more efficiently than working at home. And then you have the other people, maybe depending on what their roles are, they rather be at home because they're more productive when they are at home. So
Yeah.
I think everyone's kind of finding where they fit in and where the priority fits with them, and trading spaces, either upsizing to get a 2-bedroom, so they have, I say 2-bedroom because, of course, the condo market, you always think
Right.
1 to 2, but just
Yes.
get a larger house or home that will allow you to have that privacy for a home office. Or it's downsizing. I've seen, actually, this is a trend downtown, is that a lot of people are kind of on that cusp of retirement. So they basically are now taking early retirement because they kind of think, I think at this point, we're going to move. Maybe it's down south to Arizona. Maybe it's, New Mexico, and just do that now versus waiting for 2 years, 3 years down the road. And some are able to work from remotely, and then some are just like, no, we're just going to go ahead and retire now. And this is what feels best for our point in our life right now due to what's going on out there. So a lot of life changes. Yeah.
There's some great opportunity right now in these downtown condos.
Oh, 100%.
Great opportunity. I mean, there's some beautiful buildings, gorgeous buildings in Seattle and Bellevue that it's a great time for a buyer. If a buyer is sitting on the sideline and they want to buy a condo, it is a great time because there's some great ones to choose from. And it's probably a better opportunity now than it has been in the last 5 years. And yeah, I've seen the same type of thing where people will say, well, I'm going to buy a condo downtown. So, I can have low maintenance. I can be right in the city. I can be near my office if I want to go to my office. And then I can buy that second home in Arizona or Florida or wherever that second home is. And
I'm glad
it's
you
great.
said that, because I've been pumping that message for the past 3 weeks, just because the inventory is at an all-time high for the past 9 to 10 years. There's a lot of beautiful homes. Pricing is coming down. You have the interest rates, and really for buyers right now, specifically in that October-November timeframe, it's really just a great time for them. I do see that a lot of, and even these are the conversations I'm having with our seller clients, is okay, well, once we get through October, then we could reevaluate. Maybe we're taking off the market and we're waiting for spring, summer of next year. Maybe we're taking off the market, the owners are moving back into it. Maybe we're taking off the market and we're renting it. So it's going to create a shift in inventory of the homes that are available right now. They're not going to stay on the market. The owners will pull them. So again, if there are buyers out there that are on the sidelines, just need a little bit, more of a push or reason to get in now. If you see that home, go in there. Even if you think that you want to make a low ball offer, I always say any offer is a good offer, because you just don't know. And the marketplace truly is dependent on what the seller is willing to sell for and what the buyer is willing to buy for it. So, and nothing else. So I'd like to hear that. And I think there's a couple other colleagues out there that are also mirroring that same message right now. It's like, time is now.
Yeah. Do you find too, Ashley, that as you get into the holidays also, that the buyers that are out looking and the sellers that are selling, they're serious?
Oh, yeah.
And so I've had some of my biggest months in December, and that's because if the sellers have the place on the market, it means, hey, we really do want to sell this. And the buyers that are out looking during the holiday season, they really do want to buy. They're pretty serious about wanting to do that.
Yeah, for sure. Yeah, we don't find too many looky-loos in that December timeframe, because it does take a little extra effort to want to go search for houses when get limited daylight and it's raining and all the other back and social just with your families and the different things that are going on. So it will be interesting to see how November and December, I feel like everything has shifted in the year just because March, April, May were so shut down. Everything has been, which we normally see kind of the summer doldrums, we didn't really see that. We rolled right through it, and we're rolling right through October. You said that you're having a great October.
October's a pretty busy month. Yes.
Yeah, for closing and stuff. So I think once we see those numbers come out, and then again the holidays, maybe we do see us just kind of pushing right through this. And in downtown specifically with the condos, and kind of the state of affairs that's going on downtown too. To touch on that, I mean, it's definitely changed in the last 2 to 3 weeks. You can kind of tell there's more people downtown. There's more restaurants opening. It's starting to feel definitely more alive. And it's cleaned up, just walking around. And I've been walking around throughout this whole, the whole pandemic, just kind of witnessing everything that's been going on downtown. And it does feel like there's a little bit of a vibrancy in the air. So it's not going to take much for things to kind of switch around, especially when the companies start kind of actually coming out and saying, this is when we're planning on coming back. We're phasing our employees back, to come back to work. It'll just take off just like that. So
yeah. It's going to be interesting to watch. Yeah. And I agree. We are seeing like as things open up, there's a bit more of a vibe going on downtown. And as these COVID restrictions have come up, I saw just a couple days ago that the governor is now allowing open houses again, which is great. And restaurants, are able to do the indoor seating now, which is great for these business owners.
A lot of them are modifying how the restrictions are horrible, right? But they also made the business owners shift how they are servicing their clientele and the customers, and everyone, that I've seen, or the places that we go regularly, have all made this kind of pivot in their business, and they're all complying, and it's all safe and going that extra step to protect themselves, protect their customers and clients and all that sort of thing. So it's been interesting to kind of just see everyone evolve. I mean, we've done it with the virtual open and the masks and our limited people in the homes at a time. The open houses will be very interesting for downtown, just because a lot of the condo buildings still are not allowing a lot of visitors into the building. Not that they're as tight as they were before, but they are, they have certain showing hours, or they're only allowing certain showings for a unit per day. And that's on the stricter side of things, but I think all the buildings will adopt kind of their own policy. And we typically don't see downtown for the last 2 years for open houses. You don't see a lot of people walking around downtown, popping in and out on a Saturday and Sunday. If they're interested, they're seeing it with their client or seeing it with their agents and going out and visiting the properties too. So will be interesting. Well, I think that's, you covered everything. Thank you so much. You're so detailed, and you explained everything just so precise. And I know that everyone who views this will get so much out of it, and we'll make sure to post your contact information and continue to kind of refer clients your way. Anything else you want to touch on or end on at this point?
No, I think I think we covered some great ground. We covered some great questions that I know I get on a regular basis. And it's a great time. If you're a buyer, it's a great time. Yeah.
Good. Yeah. We'll end on that. Thank you so much, Carese.
You're welcome. Great talking with you. And have a great weekend.
Yeah. Happy Friday.
You too.
All right. Thanks, everyone. Take care. You have a great day.
Bye-bye.
Bye.